4, 5. 1 second. What's up, everybody? Welcome back to the Russell Journal. My name is Russell, and this is my journal entry for January. What is this? Thursday, January 19th, 2023. Okay. Sorry about not doing a show yesterday. They're doing some construction in my neighborhood and big new apartment complex going on. Took out the internet for the whole area here, so I didn't have internet yesterday. Otherwise, I'd have probably tried to get a hold of you guys and let anybody who watches the show know. So I do apologize about not having a show yesterday. Coming into today, I did not trade. I was watching. I just watched the chart, and I was really watching the options chain. And there's a lot of value for this in me. And as I go through the day, one of the things you can see on the day is you can see we kind of put in this little doji candle here. Some options traders will do very, very well in this environment. They will call the bottoms. They will call the tops. They will do very, very well. One of the things I've learned as I've been exploring my edge is this type of environment doesn't do very well for me. And as you can see up here at the top here, when we put in this doge right here, that day cost me dearly. That was a very expensive day for me, and where I was able to notice where my setup does not seem to have an edge is when you can identify days like this are coming, and really not that anyone should really be trying to predict this chart, but there are points where it is really viable to notice what it's going to be. And one of the things that's actually kind of cool that does sort of predict this is the options chain. If you notice, again, look on Tuesday, you had a really high premium and a lower delta. Here, go into yesterday, you had much better deltas going into this than you did on Tuesday before relative to premiums. And now this one was rough too, because this one was like 1 or 1.5 to 2. So your delta paid 1 to 1.5 compared to your premium, and your premium, would be your 1, right? So if a contract cost me 10 cents, you could find them paying 15 cents in delta. There was some of that. And I was able to get a big chunk of the money I lost back yesterday here. So was pretty excited about that. Yesterday's trade was really good. Again, coming into today, I woke up this morning. I was up at 6 o'clock this morning. 6:30 we opened. I looked at the delta. I looked at the premium, looked at the option chain. I was like, okay, I'm not trading today. And in all fairness, I would have absolutely botched today's trade. One kind of a slower day, it seemed like throughout the thing. Definitely not as aggressive as this day was, but it did seem like a little bit slower day today. And so I'm very happy to have not traded. I made notes as I watched the day unfold, what I would do, why that was wrong, why that wouldn't have worked. And basically it's one of those days where everything I would have tried would not have worked. Now, there's a couple of things that I think are really cool, because this is something that we can look at as far as like a swing trade goes. Not that I'm teaching swing trading or that I'm going to do swing trading. I think that, again, I'm really, my goal for the first 90 trading days of this year is to just collect data, understand the performance edge, or the edge of my setup, understand my performance with that edge. And that I think is really important. So I think learning to watch and wait is important, especially if you're not, because I'm not going to paper trade this. I want to do real money. Real money feels more real to me. I'm able to be much more serious with that. It feels like I'm getting more value for my time. I'm not, and the other thing about real money is I can't reset real money. I'm very guilty of trying to paper trade, and when something doesn't work, reset the account and start over again, right? Or if I screw something up from a performance angle, stuff. So I like trading with real money. I tend to try and keep the volume down, or the dollar figure down a lot. I'm not really trying to trade with large quantities of money. And things, but from tracking my performance since the middle of last December, I've been able to notice that, okay, my trade setups have this sort of edge. This is the environment, and I've been able to identify a few things as to where the environment is, where they don't have that edge. Again, other traders have different setups, and they trade a different style. A lot of that has to do with they have a different size account than I do. They have a different broker than I do. They have different rules as far as what they're at. Their financial situation is completely different, right? They can be a little more, they just have, it's just different for them. So for me, now I want to talk really quick about some of the differences. The thing that you're going to find out, and this is one of the things that I really struggle with, is that I have taken options and changed it where I'm just trading options kind of like their share prices. Okay. Like I was penny stock trading. Okay. This is not how most options traders make money. Most options traders will play what's called a spread, where they will buy contracts long and short at the same time. They will sell contracts long and short at the same time, or they will sell contracts long and buy short, or they will sell short and buy long. They play these spreads in price action, and that is so. If you've ever heard me talk about any of the stuff I talk about with the market maker, and you think none of that makes any sense to you, if you understood the concept of these option spreads, a lot of the stuff I've said about how market makers behave, and it's not just market makers, it's also option sellers or options dealers. You have a large number of these guys that play out there. And if you go back to my other show, when I came back on Tuesday, the thing I said is this has become an option seller's market for the most part. You get into these ranges where they tighten the range up in here. They tightened it. It was pretty tight. I know you have a few big days in here, but if you're an option seller trading 0 day to expiration contracts, if you're selling 0 DTEs, you just made money on all of these days, and you only probably lost money on this day, So, and if you hedged your positions correctly, if you sold puts into this day, 0 DTE puts into this day, you probably made money as well. So I really do believe that it is a options traders market. Give me 1 second, guys. I got groceries showing up here. Soon. Okay, so again, some of that's just chit chat around what I'm thinking around the market. Now, a couple of things that I want to talk about with my setup that are really kind of cool. Okay, so again, you can see here we lost the embedded reading on the daily chart. You went right back to the 18-day moving average. Okay, I'd like to enter this into evidence as proof that this concept works. Again, this is not something I thought up. This has come from a guy named Ira Epstein. He's traded markets since 1969. If you're interested in learning this setup or this tactic, now he actually doesn't even trade this. He won't trade the move from up here down to there. He's not a day trader. He is a swing trader, and he trades futures contracts. So that's Ira and how he works. I'm trying to take what he's shown me here and adapt it so that I can day trade 0 day to expiration contracts. And in all fairness, and not to him, but to what I'm trying to do is I'm only trying to trade the way I'm trading until I'm at a point where I can sell contracts. Okay. What I'd like to do is get to a place where I can learn to sell contracts. And what you can do with that is you get this point of sort of risk-free trading where you're selling contracts outside of like whatever your contract, your spread structure is. The contracts you sell pay for the structure that you have inside. And so you're really trading contracts with somebody else's money. At that point, it makes these things, and if you lose the money, it's usually money that you raised by selling contracts. If you lose on the contract structure you're long of, you're buying, you're typically losing. You're only losing the money you're selling out here. So it allows for some very interesting things further out. But right here, what we trade is we trade 0 day to expiration contracts. We trade them directionally. And so if we think the market's going up, we're going long. If we think the market's going down, we're going short. Okay. And we're only trading single legs. We do not have a call side on and a put side on at the same time. Or I don't. I say we. I'm hoping there's people out there that are listening to me and talking to me and, we're somehow together. Okay. So right now what we're trying to master is sort of the directional sort of trade as far as this goes. And this is where I think that I will be able to capture that, $125 a day, probably because, and the reason I want this is this way is, because I can't do the other thing, and I really want to understand directional movement. So when I go do the other thing, it will be, I think I can be a lot safer when I begin to put on those different structures. So if you are interested in option structures like options atom, options alpha, shadow trader, there's a ton of really great options teachers out there and guys who have courses and classes that you can take. I've taken many of them myself, been a part of many of these groups and to learn to some degree or another. So anyway, give me 1 second. I think that is my groceries. So, all right. So, that's really it. I did not trade. I think if you're not going to paper trade, watching and waiting is a super valuable thing, especially when you get into a place and you just don't know, and again, everything I could tell you today, I want to go into this. Let's go into this because here's the thing that's funny about it is it looks a lot simpler than it really is. This is what I wanted to go into. I want to go to the 15-minute chart. Okay. I want to make this bigger so I can see it. Give me 1 second while I make this for a blind person to be able to read it. Okay. All right, here we go. Okay, so you can see the price action from today. Very interesting price action. Gap down into today. You get the reversal into some type of attempt at a gap fill into the end of the day. Didn't quite get there, sold off. Okay. Now, if you look at most other charts, that gap is going to be mostly considered filled. But according to sort of my precise measurements, you have about a 40 cent. You do have about a 40 cent gap still in the chart. And so that is there's about 40 cents left on the upward movement. So you have created at the moment an island top, if you will. I don't know whether or not and again, not predicting. I don't know if they're going to put in a higher low here and then go back up and get it tomorrow or the next day or exactly what. What I would say is there's a philosophy that the market likes to try and make fools of the most people. And that I think that the most people that I have seen, again, this is just a feeling. I don't have any hard numbers. I do have hard numbers from the options chain. You can see that they did buy a lot of puts today. And the thing is really, if you want to screw those guys who bought the put holders, they will take it up tomorrow. And the reason I say that, the only reason I bring that up is because tomorrow is OpX. So you have the monthly options expiring tomorrow. it's a quote unquote sort of what they call a witching day. Again, we will see whether or not I actually bother to trade tomorrow. I find that typically those days trading op X is dangerous. Again, you will find that and I do have a recorded history of this. Op X weeks tend to have a really messed up delta ratio in them. And the other thing is, and the other thing about it is, really, if you are an option seller, the best thing you can do is figure out where those options are at and try and pin the market where you stand to make the most money on those contracts or keep the most money, and pin it in sort of a flat area against that. So I don't know. Some of the things that are pretty interesting about this, again, going back to the daily chart, if you did go back to the daily chart, you did get a doji candle, but it was off the 18-day moving average. You could be getting ready to put in some type of higher low. So what I would expect, I don't have any expectations, to be honest with you. I have kind of an idea what I think it'll do. I think it'll either bounce against, it'll go up and hit the 200-day moving average, or it'll come down and just pin against the 18-day average and stay there all day. And then at the end of the day, jerk the opposite direction, whether it goes up or down. That's just kind of what I think will happen. Really where I'm taking my cues from right now is the options tree, that options chain. If those deltas are not where I need them to be, then I have no trade edge. The delta right now is really what allows me to have an edge in this market. And so and the other thing too is there's not a lot of really super great catalysts out there tomorrow. We did have an interesting catalyst today. The unemployment did come in at new claims was 190,000, which is just insanely low. Expected was like 214,000. So as far as the catalyst goes, really you've got this point where the Fed is at liberty to continue to raise interest rates. They can raise them as long as unemployment stays low. So there's a belief that the Fed doesn't want to see low unemployment. They're wanting to see higher unemployment. So as far as the economic narrative goes, to the point of some type of stagflation, or again, I think the two scenarios that I think stagflation is probably the most likely scenario. And that's what I think is probably mostly because the labor market's so tight. I think that the cost of labor will just keep going up, and that will just ultimately hold those rates higher, or hold not the rates, but they'll keep inflation pretty sticky. That's what I think. As far as the economic conditions go, again, need to be very careful that, like, I used to make so I had like January of last year, I had about $3,600 in this account. Okay. And I was watching Steve Van Meter, and Steve Van Meter started talking about the Fed and the interest rate hikes and how it was going to tank the market. And I took what he said and I blindly went in and just loaded the boat on puts. And inside of a month, my $3,600 was gone. Okay. So what happened there? Well, we sold off, but first of all, I traded the wrong contracts. I traded the wrong dated contracts. I traded, really I did a lot of stuff, but I did based because Steve said that, the market was, that things were going to be bad for stocks. Okay. Now, if you follow Steve Van Meter and you believe what he says about stocks, or what's going to happen with stocks, you need to have like a very long dated time horizon as far as what your picture is. Okay. And this is, if you've watched his Sunday show, he does do some weekly analysis as to what he thinks is going to happen in the market. And even then that needs to be taken with a grain of salt. Something I will say about this is economists tend to make really lousy traders. Okay. And if you want any example of this, go study some of Keynes. And if you know Keynesian economics, he's an economist. His game plan was to originally try and make money through trading via technical analysis, and he just got screwed because he couldn't understand why the price action didn't match the economic behavior. So Keynes did definitely get screwed as far as being a trader goes. There's a ton of other places I can point to. Recently, I read a really cool book called Fooled by Randomness. It's a pretty interesting read. And he points to an example of in the 90s, you had guys with economic degrees playing the emerging markets, and they were playing the Russian bonds. And it was very interesting in Russian bonds. The Russian bonds had some trepidation sort of through the mid 90s, and but every time these economic guys, they would come in and be economists, were very happy about things, they were doing very well, and they would buy the dip in these, and they would always come bouncing back. Then enter the sort of collapse 97, 98, the collapse of the I don't know if any of you remember when the Russian currency absolutely collapsed around 1998. I remember being in school and they're talking about how the Russian ruble was not worth toilet paper. Like toilet paper was more valuable than the Russian ruble. And these guys who had always bought the dip, it had always worked out. They had economic blah, blah, this and that behind them. They just got obliterated. The guy he talks about loses, like, I can't remember, it was like 60 million or 300 million, somewhere in there. I think he had a position of 300 million and lost 60 million and had to leave JP Morgan Chase, like, just in a ball of tears. And so, like, again, like there's just two examples of where, like, I get the fact that economists make lousy traders, but I don't think any trader can ignore any type of catalyst. So it's probably why I think we need to talk about the economic position and stuff like that. Low unemployment. Here, this is really where you're in a tough spot because it's not really bullish or bearish, right? It doesn't really devalue in high inflation environment. It doesn't really devalue the value of stocks, right? It means there's money out there to be made. There's people making money. There's, a lot of healthy strength in the economy. The other thing about it is that the other really crazy part of this is that, but it does mean that the Fed is at liberty to keep raising interest rates. And it also means, usually you need to see a spike up in unemployment in order to get inflation to come down. So it also means the Fed's going to continue to raise interest rates, and they may raise them higher than what we expect. That 5.25% or 5.1% that they talked about may not be enough, right? They may have to keep going until they break the jobs market. So at the same time, we did get some other stuff that's beneficial. If and this is really shitty as far as like the economic conversation goes, is we got the first thing that we really needed, and that was to see earlier this week. The thing we needed to see was retail sales took a massive hit last December. Okay. The way the narrative works around battling inflation is high inflation, raise interest rates, see sales drop. The next thing that we need to see is unemployment rise up, and then you really should begin to see the beginning of inflation abate, right? That's when you should see it go down. You have those steps, they're happening. Retail sales taking, especially during the Christmas season, taking just a bludgeoning, and if you're somebody who's buying this thinking, okay, well, you're getting closer and closer to inflation being fixed and going back into an easier monetary system. If investors are buying based on that, I think it's stupid. Frankly, I actually think it's absolutely retarded. Pardon my language. I know some people don't like to use that word, but I don't mean that in you're a special kind of thing. I'm not trying to insult them. What I'm saying is it is compressed. It is slow. It is a slow form of thinking where what you're essentially saying with this is if this market only goes up because interest rates come down, the only thing that makes this valuable is the fact that money is deflated. It has nothing to do, it would then have nothing to do with actual value created within the economy, right? PE ratios and stuff wouldn't matter they have no matter based on actual business performance. You're saying the only thing that makes this worth anything is an easy access to dollars. And that's, again, I think that is a slow form of thinking in the truest sense of the word retard. So and I think that you have a large amount of this economy that has been built based on a depreciating dollar and not built on company sales and productivity and having an actual strong economy. So I think it's stupid. And I think most bears have thought it's stupid. I think if you look at most of the big bear guys, they've thought this has been a dumb thing. They think the only solution to this, however, is I think that most of them think that you look at Peter Schiff, right? A guy like Peter Schiff. And Peter Schiff wants to go to some type of gold standard. And his belief is that the only solution for this is a deflationary economy. I disagree with that. I think a deflationary economy is one where a very few number of people have all of the money, they have all of the gold, and everybody else gets whatever, shavings, whatever dust that is left behind. I don't think that that's a good system. So I believe in a deflationary economy, but I don't believe that this should be based, the value of the S&P 500 should be based on entirely whether or not it's easy to get money or not, or whether it's easy to make money. And that's what I believe. So anyway, that's kind of my 2 cents on the issue. I'm going to wrap this up. Again, no plan for tomorrow. I really want to wake up. I want to see those deltas going back in my favor. If they're not, then I'm not going to trade. And so that's fine. Keep an eye out. I'm going to do my risk report where I talk about the risk. I think I have a better handle on how those deltas affect my risk, and I'll be able to shuffle that into the video that I've been sort of crafting and creating. Anyway, the Russell Journal, written, edited, hosted by me, Russell Liss, produced by Social Media Shows. Our executive producer is Maria Pereza. Give them a check out if you're interested in having somebody help you put together a show like this. And until tomorrow, pretend I said some sort of catchphrase.